with us Max Layton. He's Global Head of Commodities at Citi. Max, hi, thank you so much for joining in. First of all, your sense on gold, because for the longest time in the last 3 months, basically, we saw a lot of consolidation happening for gold. And then suddenly, just like that, we've seen 3,500 takeaway. Are you looking at higher highs going forward for gold?
We sure are. Thanks for having me on the show. We're very bullish in the near term on gold. We think that the U.S. economy is going through a period of absorbing the largest tariffs that have been imposed in a century, and that is going to obviously raise uncertainty. That's been a big part of the driver of this year of the gold bull market, and that's going to continue over the next 3 months or so. So in early August, around a month ago, we've been bullish on gold for a couple of years now. We kind of went neutral around 3-4 months ago, and we've been kind of range trading gold, but we decided to increase the range of our base case price forecast in early August to 3,300 to 3,600, and we raised our near-term price target up to $3,500 an ounce. And it looks like, as you mentioned at the start of the show, we're already there.
Yes, we are, Max. A lot of reports do seem to be suggesting that if we can take these levels and stay above this consistently, then perhaps 3,800 or 4,000 is not too far away. Are you willing to go as high as that?
Yeah, I think part of the reason we haven't gone that high and we've got the range at 33 to 3,600 is that the world is already spending a phenomenal amount of money on gold. So if you look at the flow of gold, the value of the flow of total gold consumption or production, we're annualizing at a pace of around $500 billion, which is around 0.5% of global GDP, and that is the highest in around 50 years. And so we're already spending a colossal amount of gold, and that reflects, I think, broadly speaking, 2 things. One is fear of or hedging the downside risks in especially US asset prices, but also global growth downside risks. So there's fear about the impact of tariffs and a want to hedge that. But there's also no actual recession. And so globally, income growth is relatively strong, particularly in India, particularly in China, and in dollar income growth is decent. So jewelry demand has been super resilient. So you've got the investment demand that's strong, the central bank on the de-dollarization narrative, and you've got the still very resilient jewelry consumption because income growth in dollars in India and China is strong. So all of these things are combining to have the world spending the most that it's spent on gold in 50 years. So everything's going right at the moment. And look, we expect that to continue the near term, but it's done a lot of work. I mean, the other way you can look at just this gold price in historical context, one is to look at the value of the flow, which I just mentioned, which is super high. The other way is to look at the value of the stock of gold above ground as a share of household wealth. So if you look at the stock that households own of jewelry, of bars and coins, and you take that as a share of household net worth, you've basically gone to 50-year highs as well. So, households on average now are holding 3% of their wealth in gold, up from less than 1.5% 3 years ago. So, the world has put on this trade in aggregate and is relatively long gold, and that's part of the reason for us being perhaps less bullish than some of our peers. And then the final reason I would just say is that we're quite, confident that President Trump, that a kind of President Trump put, a U.S. growth put is in place. So if things do deteriorate, whether it's President Trump or the Fed, is there with lots of room to respond to get U.S. growth to rebound through 2026. So those factors kind of mean that we see a very shallow downturn in US growth and actually strengthening growth next year.
I get your point, Max. There's no actual recession here, but even with that, you've shared some overwhelming numbers with us. You've said $500 billion, which is the highest in 50 years, seems to be flowing into gold right now. I mean, that's like huge number there. But that's about gold, Max. And what is really bothering silver? Not bothering really, but the kind of run-up that we've been seeing in silver in the last couple of months, it's clearly outperforming gold at $41 an ounce, almost there. How are you looking at silver prices in the foreseeable future?
Thanks. Yeah, that's been our big call over the summer that silver
Yes.
would do well. We've got a near-term target of $43. We think silver speaks to both it's partly driven by the bullishness in the gold market, but it also has its own supply-demand balance outside of the investment component, which is still very strong. Although there's a lot of headlines about solar weakness in China and more broadly globally, actually the output of solar panels is still going strong, and the substitution isn't particularly large. Anyway, silver's in deficit. It's a deficit market, and you basically need to incentivize stockholders to sell their inventory of silver, and they're requiring higher and higher prices and to do that. And that's essentially what's going on in this market. It's a combination of fundamental tightness and investors wanting some kind of leveraged exposure to gold. Gold by historical standards is not cheap. Silver was cheap, is getting less cheap. But it has a historical upside up to $50. We haven't gone all that way, but we think we're gonna rise another 5 to 10% from here in the very near term.
Max, what is also your sense on the dollar index? Because that would really define going forward on how gold and silver behave. At this point in time, it is under tremendous pressure. And if the US Fed would start cutting interest rates, would you say further support here? There again are some banks and brokerages calling dollar index at 95 and 92, and some of them have been as bearish as 87.
Wow. So yeah, I mean, look, our house view is moderately bearish the dollar in the near term. So over the next 3 months, they do expect the dollar to depreciate, certainly against the euro and also more broadly. And that is going to be supportive for gold, no doubt about it. I think it's also going to be supportive for silver. And, a lot will depend on why the dollar's going down. The house view is that it goes down because US growth, the labor market, slows down, and that the Fed cuts as a result of that. And so our house view has quite a few more Fed cuts than I think consensus. And yeah, all of that speaks to higher gold and silver.
So what is Citi sense then? How many rate cuts? One, and what is the view on dollar index as in sense of a price point?
So yeah, our house view is consecutive rate cuts through March of next year, taking us down to 3 to 3.25%. So significant cuts is the house view. I think if that happened, that would be probably more in line with our bull case on gold, and you would see higher than 3,600 in that world.
Max, gold and silver, both with the kind of run-up that we've seen here, and the central bank buying has been strong as well. So for gold, we understand 1,000 tons perhaps here or there. But with silver central bank buying, especially coming in from Russia and Saudi Arabia, are you reading a lot into that?
Sure. Yeah, so in the gold space, I would say the central bank narrative takes a huge amount of investor mind share. It works out that actually central bank demand is only about 25% of mine supply, so it's only absorbing 25. Perhaps it's taken 80, 90% of the mine share, but it's a quarter of the story. In silver, there is a lot of interest in central bank buying. Unfortunately, the data is super opaque, even more so than it is in gold. So it's very hard to tell exactly how much is going on. Obviously, silver is you have to store a lot more volume of silver to get the same dollar exposure. So central banks haven't traditionally moved in a major way into silver, and frankly, I don't expect that they will. So it's supportive, but probably not a big driver of the silver going forward.
Sure. Max, also, when it comes about central bank buying gold, and you just talked about those numbers, if you look at the last 1 year data, and this has been collated by various agencies which say that in the last 1 year or perhaps more, the gold buying has been way more than the dollar treasuries, the US treasuries, that is. Have you seen that pattern, and do you see it growing further?
Sure. So the numbers that I were quoting were volume numbers. So the volume of gold buying by central banks, it's been running at about 1,000 tons a year. We produce around 4,000 tons of gold mine supply. So they've been absorbing about a quarter of the mine supply. That hasn't changed. What has changed is it's changed a little bit. There's a little bit less buying this year. It's come off a little bit from 1,000, but what has changed is the gold price. So essentially, investors have come in both through ETF, also ultra high net worth family office. They've come in, bought a huge amount of gold this year. That's contributed to the big rally in the price, certainly this year. And that has raised the cost of buying that 1,000 tons that the central banks have been buying for the last 3 years. And obviously over the last 3 years, that price of gold has doubled. And that means that they're paying double to buy the same volume.
Yes, they are.
And that's where it's coming from. So this talk about how they've increased gold as a share of their foreign reserves is actually coming entirely through the price action.
It sure is, and perhaps that is leading to all of this price action as well. But Max, since we have you with us, what is also your sense on the base metal prices? Because there is this, the run-up that we saw in copper and then that profit-taking, it seems to be now consolidating, but there is some support here. So when I look at the markets this week, copper, zinc, iron ore, steel, everything seems quite supported. What are your targets going forward for some of these?
Yeah, sure. So, on the one hand, the tariffs and the still high US interest rates are bearish for growth. On the other hand, that impact on the supply-demand balance and on sentiment on base metals, that negative impact is being largely offset, if not wholly offset, by the weaker dollar and by the prospect of an eventual kind of recovery and moving once the tariffs are absorbed and, the One Big Beautiful Bill Act kicks in and rates are cut globally. People are kind of looking through the tariff impact and these factors are kind of netting out with prices doing essentially nothing in base metals over the last few months. Going forward, we're essentially cautious on the base metals until the worst of the tariff impact on growth and inflation is past. So we're kind of rolling cautious on base metals near term, but very, very bullish on, in particular, aluminium, but also copper on a 12 to 24-month view. So heading into the midterms and with lower interest rates globally, we do expect a pickup in global growth. They've got a lot of exposure to decarbonization as well as AI and data center related demand. And they have practically no supply growth, these markets, copper and aluminium. So they're set up for when the global economy turns, they're set up for super bullish markets, but just not yet.
Super bullish. I like that word, Max. Just before I let you go, would you want to give us some numbers then in copper, aluminum both? What are you looking at in 12 to 24 months in sense of prices?
Sure. Yeah. So, copper, you can be talking about on that kind of time frame, $11,000 to $12,000. Aluminium, you can be talking about easily $3,000 plus.
All right, very, very bullish cues coming in, not just in case of metals, but gold and silver as well. And there's just so much to watch out for the international markets there. Max Layton, as always, thank you so much for coming by and making sense of what really is conspiring in the international markets and what can we watch for. We appreciate your time here at CNBC TV 18.